But what I want to talk about right now is, let's get pragmatic. What do I really mean by investing in a risk-free asset? And first of all, there is nothing risk-free, of course. We just use the term risk-free the way academics do all the time. We say ridiculous things like that. But nothing in life is truly risk-free. But we mean these extremely low credit risk, short maturity instruments. But I want to flesh that out in even more detail. I'm getting a little warm here. I hope you don't mind me taking off my jacket. So I'll be happy to field questions, but let me throw out a few ideas here. One thing that most people are immediately thinking about, I would assume here, is that I'm talking about US dollars. Well, actually, I'm not talking about investing just in a US dollar portfolio. Why a person thinks that if their wealth today is $1 million and their wealth tomorrow is $1 million, they haven't lost anything, isn't true. Dollars go up and down in value, just like other things go up and down in value. And we want to be careful with an idea which says that if our wealth has a small amount of variation in US dollar terms, then our wealth really isn't changing in true value. So I would argue that it would be perfectly acceptable for some people to take this short-term money and to keep some of it in US dollars and maybe put some of it in euros and British pounds and Swiss francs and Japanese yen, etc. and so forth. Have a more internationally diversified holding of their currency. Now, I'm not, that can be argued either way in my opinion. There's a lot of theories about wealth, that wealth is not so much how much money you have. This is going to sound awful, but stick with me. It's really not how much money you have that makes you important. It's how much money you have relative to the people around you that's important. And it is funny, but I don't mean it sarcastically. If we were in a third world country right now, and one of us had a $50,000 portfolio, they'd probably be the wealthiest person in the room. And if this were Beverly Hills or whatever, they'd be the poorest person in the room. And our wealth is very much determined by the wealth of people around us. And most Americans hold most of their wealth and think about it in terms of US dollars. So if somebody tells me that, no, I want to keep all of my money denominated in US dollars, that might be a reasonable answer. But I think if somebody else says, you know, I'm worried about the US dollar, I'm worried about hyperinflation, I would argue that if you keep your money short-term enough, if we go into a hyperinflation, like we kind of did in the late 1970s, that if you keep your money short-term enough and keep rolling it over into the higher interest rates, you can hedge that some. You could certainly get in these Treasury inflation-protected securities, tips, to handle some of that for yourself. But, so the first point I make is that I'm not necessarily arguing that this should all be in US dollars. That's a difficult issue. Either way I think would be appropriate. But what I tend to do, I'll tell you what I do with most of my family's money. When I say my family's money, it sounds like they're rich. They're not, believe me. Especially after I manage their money. No. I love, in this market environment at least, I love FDIC insured certificates of deposits. And I'll tell you what I do. I do a laddered strategy. Now, what do I mean by a laddered strategy? I take, for instance, my brother. Let's say that he wanted $300,000 of his money. He's retired. $300,000 of his money in the short-term portfolio. That's what he picked. Let's say. So what I might do is take $100,000 and put it out in a 3-year CD, because banks tend to pay higher yields on 3-year CDs in general through time than they do on 2-year and 1-year. So I'm going to start out with $100,000 in the 3-year portfolio, $100,000 in the I meant to say CD, $100,000 in the 3-year CD, $100,000 in the 2-year CD, and $100,000 in a 1-year CD. And then a year later, what do I have? Well, they've all shifted in maturity, so now I've got $100,000 in a 2-year, $100,000 in a 1-year, and $100,000 that's come due. So I take that $100,000 and I roll it back into just a 3-year. Follow? So a year later, I do the same thing. Well, now I'm always investing in 3-year CDs, but at any particular point in time, I have a spectrum of maturities between 0 and 3 years. Are you with me? This is called a laddered approach. And you don't have to do it with big clumps of money like $100,000. What I did with him, I think, is I put $50,000 every 6 months out for 3 years. And now every 6 months, the money comes due. If he needs a minimum required distribution or he wants some money out of his IRA, it goes out of his IRA. If it stays inside, I roll it over into a CD. Don't have to pick exactly 3 years. I might look at rates, and if there's a particular FDIC insured bank that seems to be offering a bunch more yield at 3.5, I'll throw it out at 3.5. And now, is this just me, speculating and hypothesizing? Well, there's actually a little bit of theory behind this. In addition to the theory I've talked about here, we have a general interest rate theory, this idea of interest rates through time, the term structure of interest rates. And that argues for the idea that if you keep a lot of money ultra short term, you're going to be paying a tremendous premium for that liquidity. And we see that when we go to a bank. We ask them, what's your money market rate? They say 0.4%. Well, how can I get more than 0.4%? Put it out at 1 year, we'll give you 1%. Put it out at 3 years, we'll give you 2%. And you say, but look, I'm worried that if I put it out there in a 3-year CD, interest rates are going to shoot upward and I'm going to regret this. So the way to balance this off, this liquidity that you like versus the higher yields of investing a little longer term, in my professional opinion, in today's environment, would be to try this laddered sort of approach. Other people, correctly and wonderfully, might argue, why not just go with these TIPS, Treasury Inflation Protected Securities? I would certainly keep some of my money in a money market fund or money market account so you have some liquidity. But that's kind of what I would have in mind for the risk-free asset. So, good time for questions.
Along the CD strategy, lately a lot of institutions have these step-up 3-year securities, or CDs. 2-year step-up, 3-year step-up. Have you developed any personal strategies to utilize those and relook at them 50% of the way through their life?
No, I haven't. The question was, I've really been talking about a plain vanilla CD. You put your money in a 2-year CD, they hold it for 2 years, it comes due, end of story. And there are CDs that will have stepped up rates. There are some CDs that will be index linked. They'll say that if the stock market goes up, you get the better of a very low interest rate or maybe some appreciation from the stock market going up. And that would just have to be done on a case-by-case basis. I haven't seen anything great there. What I have seen really great is that your hometown banks will often have very attractive CDs, and it's kind of like going to Price Chopper, a grocery store or whatever, and they'll sell you a pint of blueberries for $1. Well, they're just trying to get you in the door to cross-sell you into other business. But I'd scan them, one thing I would look for is I would scan the local banks to see if there's a bank that's offering some special CD, and I think those are great to cherry pick. The ones that have like step-up rates and things like that, there's no free lunch there. They're gonna structure those so that generally, from mostly what I've seen, they're not necessarily better. I actually have seen a few, as I come to think about it now, where they perceive the bank's risk is so reduced by offering those that they do give you a pretty attractive yield.
Well, what I found today, for instance, a 2-year was 2.35, a 2-year step-up was 2.15. Yeah. So virtually the same, with the option that if we are in a high inflation rate environment, you get 3% of the way through, I can call them and say, bump it up.
Yeah, they've probably done the math pretty well on that one. The markets, in my opinion, aren't predicting a rapid rise in interest rates.
I found shopping around to local banks to invest CDs at a higher rate for a retirement fund, so to speak. Once the term is over, they don't have much to offer in terms of any high yield rollover for the CD, plus they charge you if you want to move it somewhere else.
Inside of an IRA, really, there's a fee to move your IRA?
If you're moving it outside of that particular bank.
That's right. Wow. Thank you for telling me that. I wasn't thinking in terms of an IRA at that point when I was recommending this. I'll tell you how I do it. I have a discount brokerage where they show me CDs from all around the country. And I click, and I just pick off the bank that just seems to be offering the highest rate at that time. And I'm not pushing any particular brokerage. I don't get a kickback. Mention my name when you call. But I'm thinking of Schwab right now. And other firms that you found good CD selections. Anybody want to tell me one?
Bankrate.com.
Okay, that's not, that's just a web-based thing that'll tell you where you can get those best CDs, right? Good.
What are your thoughts about Zvi Brody's idea that U.S. tips are really the only worry-free, risk-free investment, and he argues that's where you should put your assets?
Well, what about tips? A lot of people say what are tips? They're U.S. Treasury backed. That's great, but I don't think it's greater than the FDIC. They are indexed to inflation. That's great. But if you keep your, but inflation doesn't happen in a day or two. Inflation happens in years. And I think that if you keep your money outside of tips short enough, you'll be able to roll over as those inflation occurs. A problem I have with treasuries is that if you invest in a retirement plan, treasuries have a tax advantage. The tax advantage of treasuries is that they, generally speaking, are exempt from state income taxes. So you don't want to take an asset that has a tax advantage and put it in a vehicle that doesn't use that tax advantage. So if you buy tips into a retirement account, you're wasting a little bit of tax advantage there. But holding a tip outside, if you're in a state that has high taxes, and I think most of you are, whether you came from New York or from Massachusetts, you're in a high tax bracket state, they would probably make sense, especially outside of retirement plans. Inside of retirement plans, I think I'd stick with short-term CDs. But it's a great question.